Welcome back to the Pro Ticker Deep Dive podcast, everyone. So get this, Apple and Microsoft, uh, they both just crushed their earnings estimates, which usually gets investors excited, right? But here's the weird part. Their stocks actually dipped. Apple went down like 4%, and Microsoft had a way bigger drop, like over 7.5%. So we're going to take a deep dive into why the market is reacting this way to what seemed like great results.
Yeah, what's really interesting here is that the market isn't really just reacting to what happened. It's looking ahead,
Yeah.
and sometimes good news can be overshadowed by concerns about future growth and challenges. So even though these companies are doing really well right now, there's some hesitation about what's coming next.
Okay, so let's start with Apple. They beat both revenue and earnings estimates, which sounds like a win, right? But something's making investors nervous.
Right. And one thing that's making investors hesitate is Apple's own prediction for revenue growth next quarter. They're projecting growth in the low to mid single digits, which, isn't terrible, but it is less than what analysts were expecting. And, investors are all about anticipating future performance. So this kind of less exciting guidance definitely caught people's attention.
So it's like they aced the test, but then they're saying, might not do as well in the next one. No wonder investors are kind of spooked.
Yeah, exactly. It's about momentum, And then there's this whole thing about AI. There's all this hype about how AI is going to revolutionize Apple's products,
Yeah.
especially the iPhone. But, the reality is the rollout of those AI features, it's been slower and more limited than some people thought it would be. Some of the new AI features are only available in English-speaking countries right now.
Yeah, that makes sense. Investors are probably thinking, okay, AI is the future, but when is it actually going to impact Apple's bottom line?
Yeah. Yeah.
And they don't see enough evidence to get them truly excited.
Yeah, you're exactly right. AI could be a total game changer. But it's still early. The market wants to see proof, not just promises.
Okay, so we've got these growth concerns, and then the questions about AI, all kind of casting a shadow over Apple. But then there's also their valuation, right? Apple's been doing really well for a while now.
Absolutely. Apple's currently trading at what's called a forward price to earnings ratio, or PE ratio for short, of 30.5x. And to put that in perspective, that's higher than it's been in the past 5 years. Basically, investors are paying more for each dollar of Apple's expected earnings. Now, a high PE ratio isn't necessarily a bad thing, especially for a company like Apple with its track record, but it definitely sets a high bar for them to keep performing well.
So to justify that higher price, they really need to deliver impressive earnings growth.
Exactly. And that's where things get a little tricky. Analysts are projecting that Apple's earnings per share, or EPS, will grow by about 9% over the next few years, which is, decent growth, but it's not necessarily enough to justify that current valuation, especially considering how well they've done in the past.
So it's like they're asking for a lot of trust based on their past success, but the future isn't so clear-cut.
It's a great way to put it. There's also this other metric called the PEG ratio, which takes that PE ratio and combines it with expected growth to give us a more complete picture. And right now, Apple's PEG ratio is higher than its historical average, which suggests its valuation might be a little inflated. Think of it this way. Would you rather buy a used car with high mileage but a low price, so low PE but high growth, or a newer car with fewer miles but a much higher price, so high PE but lower growth? It's about balancing risk and reward.
Okay, that actually makes it a lot clearer. So investors are hesitant to buy Apple stock at its current price. Even though the company's doing well fundamentally, it's like a really nice house with a price tag that's just too high.
Exactly, and that's reflected in that 4% dip. Now let's switch gears to Microsoft. Remember, they also beat their estimates, but their stock dropped even more, over 7.5%. So what's going on there?
Yeah, that's a pretty steep drop. What's making investors so nervous about Microsoft?
Well, there are two main things driving that reaction. One is how much they're spending on AI, and the other is a slowdown in their cloud business.
Okay, let's break those down. First, the AI spending. We all know Microsoft has put a ton of resources into AI development, especially with their partnership with OpenAI. But is that making investors nervous?
It seems like it. Microsoft said they're expecting a $1.5 billion hit to their income this quarter because of these AI investments. That's a lot of money. And it shows that their AI ventures are still pretty new. It might take some time for those investments to actually make a profit. And investors, they can be impatient.
So it's a gamble that could pay off big. But it's going to take time. And the market doesn't like waiting.
Right. They're playing the long game, which requires trust from investors.
And speaking of trust, let's talk about the cloud slowdown. Their cloud platform has been huge for them. It's driven a lot of growth, but now it seems like that's slowing down. Last quarter, their year-over-year growth was only 33%. which is still decent,
Mm-hmm.
but it's less than what investors are used to, and they're expecting even slower growth next quarter.
Okay, so the cloud isn't going away, but the growth isn't what it used to be. Is this a sign that the cloud boom is over? Is that what's got investors worried?
Well, it's not that simple. The cloud market is still growing, but there's more competition now. It's getting crowded. Microsoft is facing some serious rivals in cloud computing, and some of them are actually seeing their growth speed up.
Ah, so it's not just about how big the whole market is. It's about how much of that market each company can get, and Microsoft might be losing some ground.
Exactly. It's a battle for who's going to control the cloud, and investors are paying close attention to how it plays out. So we've got Apple dealing with growth concerns, AI uncertainties, and a potentially inflated valuation. And then we've got Microsoft wrestling with big spending on AI. And this slowdown in their cloud business, it seems like both companies are facing challenges. But they're very different challenges.
Yeah, exactly. And those different challenges are making investors react in different ways. Remember, we were talking about analyst ratings. Well, right now, Apple has what's called a moderate buy rating, while Microsoft has a strong buy rating. It's like the experts are giving Apple a cautious nod, but they're giving Microsoft a much more enthusiastic thumbs up, even though Microsoft's stock took a bigger hit after the earnings report.
So it's like investors are more willing to overlook Microsoft's stumbles
Yeah.
because they think they have a better future. They're giving them the benefit of the doubt.
That seems to be the case. Analysts are still pretty optimistic about Microsoft's potential, especially in the cloud and AI areas. They believe that Microsoft's investments will pay off eventually, even if there are some bumps along the way.
Okay, so maybe the market is overreacting a little to Microsoft's short-term challenges and not giving them enough credit for their long-term plan. It's like judging a marathon runner based on their first mile.
That's a good way to think about it. It's important to remember that the stock market can be short-sighted. They focus on the immediate concerns, and they often miss the bigger picture, the potential for long-term growth. So if Microsoft, we're seeing a company that's investing a lot in the future, even though those investments are causing some short-term pain, analysts believe these are strategic moves. That could lead to really big rewards down the road.
That makes sense. So both companies are on a journey, but they're taking different paths. And investors are trying to figure out which path is more likely to lead to profit.
Exactly. And to really understand those paths, we need to look a little deeper. Like, what are analysts saying about Apple's valuation? And Microsoft's AI spending? What are the things that are going to drive their future growth? We'll dig into these questions and more in our next segment.
Sounds good. Stay tuned, everyone. Things are about to get even more interesting.
Welcome back to our deep dive. We've talked about the big picture so far. Apple beating expectations, but facing those worries about growth and valuation, while Microsoft is dealing with those big AI investments and that cloud slowdown. But to really get into the details, let's look at what the analysts are saying.
Okay, so let's dive into those analyst opinions. I know we always say you should do your own research and not just follow what anyone recommends, but it's still interesting to see what the so-called experts are thinking, right? You can give us some insights.
Absolutely. Analyst ratings and price targets can be like a helpful gauge of Wall Street sentiment, even though they're just one piece of the puzzle. So let's start with Apple. The overall consensus right now is moderate buy, which basically means that most analysts think the stock has a decent chance of doing better than the market over the next few months.
Okay, moderate buy. So some optimism, but not like crazy excitement.
Exactly. It's more of a cautious, like, yeah, this is probably okay. Out of the 33 analysts covering Apple, 23 recommend a buy, 8 suggest a hold, and only 2 recommend a sell. So most are positive, but a good number are either unsure or a bit negative.
Interesting. What about the average price target? That can give us an idea of how much they think the stock could go up.
Right. The average price target for Apple is $247.32. That's about 10% higher than the current price.
Okay, so not a huge gain, but still a decent return if it happens. It's like, yeah, Apple might be a little overpriced, but there's still a chance to make some money if you're patient.
Exactly. Now let's move on to Microsoft. Remember, their stock actually dropped more after their earnings, but analysts are way more optimistic about them. They've given it a strong buy rating, which shows a lot more confidence in their future.
Wait, so even though Microsoft had a bigger dip, the experts are actually more positive about them long-term than Apple. That's kind of weird.
It is interesting, right? It seems like analysts are looking past those short-term problems and focusing on Microsoft's long-term potential, especially in the cloud and AI areas we talked about before. Out of the 30 analysts covering Microsoft, 27 recommend a buy, and only 3 have a hold rating. It's almost everyone.
Wow, that's pretty strong. It's like they're saying, yeah, Microsoft might be struggling a bit right now, but we think they're going to come out even stronger.
Yeah, that's a good way to put it. And you can see that confidence in the average price target for Microsoft. It's $503.15 right now, which means they think it could go up by about 22%.
So potentially a lot more upside than Apple, at least according to these analysts.
Right. Of course, it's important to remember that analyst opinions are just one factor. And like you said earlier, you should always do your own research. Think about your own investment goals and how much risk you're comfortable with, and maybe even talk to a financial advisor before making any decisions.
Absolutely. We always want our listeners to be smart investors, not just
Yeah.
following someone else's advice, even if they seem like experts.
Right.
But it's still useful to know what the smart money is thinking, right? It helps us see things from different angles.
Exactly. And sometimes the most interesting perspectives come from people who disagree with the crowd. You know, those contrarian viewpoints?
Ooh, I love those. It's like, okay, everyone is saying this, but what if they're all wrong? What if there's something else going on that we're missing? So let's get a little rebellious. What are some other opinions about Apple and Microsoft that maybe people aren't talking about as much?
Well, one interesting thing about Apple is maybe they're becoming too dependent on the iPhone. Don't get me wrong, the iPhone is still an amazing product, and it makes them a ton of money. But some analysts are saying that for Apple to keep growing in the long term, they need to have other sources of revenue. They can't rely so much on just one product.
Yeah, that makes sense. It's like even the best athlete can't play forever. Eventually, you need to find new talent and build a more well-rounded team. And I know Apple has had some success with their services, like music streaming and video streaming, but that's still a pretty small part of their business.
Exactly. And some investors are worried that Apple hasn't found that next big thing yet, you know, the thing that will be as big as the iPhone. They're still looking for that next hit product.
Like they need to find a worthy successor. Okay, so that's the contrarian view on Apple. They're too reliant on the iPhone.
Yeah.
And they haven't found that next big thing yet. What about Microsoft? What are some of the less talked about concerns about their future?
Well, one worry is that even though those big AI investments are promising, they could also end up costing a lot of money if they don't work out. Remember, AI is still changing really fast, and there's no guarantee that Microsoft will stay ahead.
I mean, kind of like the Wild West out there in the AI world. What's hot today could be gone tomorrow. And someone else could come along with a better AI technology or business model.
Exactly. And some critics say that Microsoft is trying to do too much at once. They're involved in cloud computing, gaming.ai. Maybe they should focus more on their strengths and not get distracted by so many new things.
It's like they're trying to be good at everything. But they might not become the best at anything. Maybe they should focus their energy on just a few key areas.
That's what some people are saying, and this brings up a really important point about investing. It's not just about seeing the opportunities. You also need to understand the risks.
So even if a company seems like it's doing great and has a bright future, there are always things that could go wrong.
Absolutely. No investment is completely safe. And that's especially true in technology because it changes so fast.
Okay, so we've looked at the analyst consensus on Apple and Microsoft, but we've also talked about some alternative perspectives. We've looked at them from all sides, the good and the bad. But I'm still wondering, what does this all mean for the average investor? You know, someone who's trying to decide whether to buy these stocks.
Yeah, that's the big question, isn't it? And like I said earlier, there's no easy answer. But I think this deep dive has given us some valuable information that can help people make better decisions.
So what are some key takeaways for our listeners as they're trying to figure out this whole tech landscape?
Well, first of all, it's clear that both Apple and Microsoft are facing challenges, but they're very different challenges. Apple needs to deal with those worries about its valuation and show that it can keep innovating and growing beyond the iPhone. Microsoft needs to show that those big AI investments will pay off and that it can compete in the cloud computing market.
So it's not just about picking between Apple and Microsoft. It's about understanding the risks and opportunities for each company and deciding which one, if either, fits better with your own investment style and goals.
Exactly. Investors need to decide for themselves whether the potential rewards are worth the risk.
Right. And they should make those decisions based on their own situation, their goals, how much risk they're comfortable with, their overall financial picture. What works for one person might not work for another.
That's a really important point, and it leads us to another takeaway. Technology is always changing, and investors need to stay informed and be ready to adapt.
So you can't just buy these tech giants and hold them forever,
Yeah.
assuming they'll always go up in value.
Right. Investors need to be more active now. They need to be more involved and more willing to change their portfolios as new things happen. It's about staying ahead of the curve.
Okay, so being an informed and adaptable investor is important. What are some of the big trends that investors should be watching in tech right now? What are the things that could make or break a company in this fast-changing environment?
Well, we've already talked a lot about AI and cloud computing. Those are definitely two of the biggest forces in the industry right now. But there are other new technologies to keep an eye on too. Things like augmented reality, virtual reality, the metaverse, blockchain, even quantum computing. All of these things have the potential to completely change industries and create big opportunities for investors who can see the winners early on.
Wow, that's a lot to keep track of. It feels like the tech world is moving so fast, it's hard to even understand all the new developments, let alone figure out which ones are really important and which ones are just hype.
Yeah, it can be overwhelming, but that's also what makes investing in technology so exciting. The potential rewards are huge, but so are the risks. It's a high-stakes game.
Okay, so we've covered a lot today. We've analyzed Apple's mixed results, Microsoft's big stock drop, looked at analyst opinions, explored some different viewpoints, and even talked about the future of tech. My head is spinning.
Mine too.
Hmm.
But it's always fun to dive into such a complex and fast-changing industry.
Well, I'm glad we could bring our listeners along for the ride. Hopefully they've learned something and are feeling more confident about investing in tech.
That's what we hope for. We want our listeners to make smart decisions and feel good about their ability to navigate the world of finance.
Absolutely. So that's it for part 2 of our deep dive into Apple and Microsoft. But don't go anywhere, because in our final segment, we're going to summarize everything we've learned and leave you with something interesting to think about.
I'm looking forward to it. It's always good to take a step back and see the big picture.
Exactly. Stay tuned, everyone. The best is yet to come. All right, welcome back to the deep dive. We spent the last 2 segments really digging into Apple and Microsoft's earnings. We looked at the market's reaction, we talked about those analyst opinions, and even considered some of those less popular viewpoints. It's been quite a ride.
It has, yeah. We've found reasons to be both optimistic and cautious about these big tech companies.
Exactly. And now for the grand finale. Let's try to sum up everything we've learned. So what are some key takeaways for our listeners, as they try to navigate this complex tech world?
Well, one of the most interesting things we saw is how differently the market reacted to Apple and Microsoft. Even though both companies did really well in their earnings, it shows that these days just meeting expectations isn't enough to impress Wall Street.
Yeah, it's like investors are looking for more than just good numbers. They want a good story about future growth, especially in areas like AI and cloud computing. Those are the hot topics right now.
Great, and that's where things get interesting. Apple, with its huge brand and loyal customers, is facing some questions about whether it can keep growing, especially without a clear next big thing to follow the iPhone.
Yeah, it's like they need that next hit song.
Exactly, and their high valuation adds even more pressure. Investors are paying a lot for Apple stock, so the company needs to deliver big results to prove it's worth it.
Then there's Microsoft. Even with those big AI investments and that slowdown in their cloud business, a lot of analysts think they have even stronger growth potential in the long run.
And their valuation is more reasonable compared to Apple, which makes them more attractive to some investors.
So we got these 2 giants, each facing its own challenges. Apple needs to show that it can keep innovating and find new sources of revenue beyond the iPhone. Microsoft needs to prove those AI bets will pay off and that it can stay competitive in the cloud.
And for investors, it's about understanding those differences, weighing the risks and the opportunities, and deciding which company, if either, fits their own goals.
Right. It's not about following the crowd.
Yeah.
It's about making your own informed decision.
Exactly.
There's no right or wrong answer here. But this deep dive has hopefully given our listeners some things to think about so they can make those decisions with more confidence.
I think we've done that. We've presented the facts, shared our thoughts, and hopefully started some interesting conversations.
Absolutely. And now for the final thought. What if the real story here isn't just about Apple versus Microsoft, but about a bigger change in how investors are looking at tech companies?
Ooh, that's interesting.
What if the market is becoming more focused on long-term growth and less impressed by just hitting those short-term earnings targets?
That's a really thought-provoking idea, and if it's true, it could have a big impact on the entire tech industry.
Yeah, companies would need to be more innovative, more adaptable, and really focused on delivering value.
It's a great point to leave our listeners with. It makes us think about the bigger picture.
So on that note, we'll wrap up this episode of The Deep Dive. Thanks for joining us. We hope you've learned something new and feel more prepared to navigate the exciting world of tech investing.
It's been great diving deep with you all.
Until next time, keep learning, keep exploring, and keep investing wisely.